With so many voices on YouTube giving advice on how to invest your hard-earned money, it can be tough to know who to trust. Some experts recommend safe investments like real estate, while others suggest putting your money into stocks that pay dividends and provide a passive monthly income. There are also those who advocate for investing all your savings in cryptocurrencies. In today's video, I'm going to dive deep into this topic and rank the investments that I consider to be the best, all based on a detailed and substantiated analysis. To do this, we need some criteria, which are potential return. Investments with high potential returns may rank higher, but this should be weighed against other factors, such as risk. Risk considers the volatility of the investment and the likelihood of capital loss. Liquidity measures how easily an investment can be converted into cash without losing value. Accessibility assesses the minimum amount needed to invest and the ease of access to the investment by the average investor. Diversification. Investments that offer good diversification of risks and returns may be more valued. Regulation and security considers the level of regulation and legal guarantees associated with the investment, which can affect the perception of security and stability. Tax impact assesses the tax implications of the investment. Time horizon relates to the time needed for the investment to reach its full potential. Well, without further ado, let's move on to our first type of investment. Stocks. Stocks represent small parts of a company that, when purchased, make the buyer one of many owners of that company. This means that by investing in stocks, you are putting your money into the future success of that company. If the company does well, the value of its shares rises, and you can sell your shares for a higher price than you paid, profiting from the difference. Investing in stocks is known for offering high potential returns. Historically, the stock market has yielded more than other forms of investments, such as bonds or savings accounts, especially in the long term. However, the price of stocks can be quite volatile, rising and falling quickly based on factors such as company performance, economic conditions, and even global events, which introduces an element of risk. In terms of liquidity, stocks are generally considered highly liquid, meaning they can be quickly converted into cash, especially if they are from large, well-established companies listed on major stock exchanges. Accessibility is also a strong point of stocks, as many investors can start with small amounts and buy shares through online brokers without the need for large initial investments. As for diversification, investing in stocks offers the possibility of diversifying your investments by choosing stocks from different sectors, geographies, and sizes of companies, which can help mitigate risks. The regulation of the stock market is strict, providing a certain level of security and transparency for investors. Generally, there are taxes on capital gains and dividends. Considering its time horizon, stocks are more suitable for long-term investments, given that the market can be volatile in the short term but tends to appreciate in the long term. Based on the above criteria, stocks can be classified in Category A of our tier list. They offer a good balance between high potential return and moderate risk, well suited for investors looking for capital growth in the long term, and are not bothered by market fluctuations in the short term. 2. Debt securities. Debt securities, or bonds, are considered safe investments that involve lending money to the issuer, which can be a government or a company. In return, the investor receives fixed interest throughout the life of the bond, and the principal amount is returned upon maturity. This type of investment is ideal for those looking for a stable source of income and have a greater aversion to risk. The great advantage of debt securities is their predictability. Interest payments are known in advance, which provides a regular and reliable income stream. This is particularly attractive in uncertain economic environments or for investors who need a steady income, like retirees. However, the potential returns from debt securities are generally lower than those from stocks, reflecting the lower associated risk. Liquidity can vary depending on the type of bond. Government bonds are generally very liquid, while corporate bonds may be less liquid, especially if issued by smaller or less established companies. Bonds can be acquired individually or through investment funds that aggregate different types of bonds. making them accessible to investors with different initial investment capacities. The bond market is well regulated, providing an additional layer of security for investors. The tax burden on interest received varies according to local legislation, but generally, bonds are considered tax efficient, especially municipal and state bonds in some jurisdictions, which may offer tax exemptions. Considering the need for a long-term investment with lower risks and stable returns, debt securities are ideal for conservative investors, and their classification in our tier list reflects their nature of low risk and moderate return. Thus, they are firmly positioned in Category B of our tier list, balancing safety and stable income with moderate liquidity and accessibility. 3 and 4. Mutual funds and index funds. Mutual funds and index funds, or ETFs, exchange-traded funds, are collective investment options that allow investors to access a diversity of assets without the need to purchase each one individually. Both offer professional management and diversification, but there are significant differences in how they are managed and traded. Mutual funds are actively managed by fund managers who select and monitor the assets with the aim of outperforming the market or achieving specific investment objectives. This active management can potentially offer higher returns, but also involves higher management fees and often requires a more substantial initial investment. On the other hand, ETFs are generally passive, meaning they replicate the performance of a specific index, such as the S&P 500, and are traded on stock exchanges, making them as accessible as individual stocks. ETFs tend to have lower management fees and do not require a large initial investment, making them an attractive choice for investors seeking simplicity and cost efficiency. In terms of liquidity, ETFs have the advantage as they are traded like stocks, allowing investors to buy and sell their shares during market trading hours, with prices fluctuating throughout the day. Mutual funds, on the other hand, are traded at the closing price of the day, which may limit the flexibility in buying and selling operations. Both types of funds offer diversification, as they invest in a variety of assets, reducing the risk of concentration in a single investment. To conclude, ETFs tend to be a more attractive option for most investors, especially those who value flexibility and low costs. Therefore, they are classified in Category A of our tier list. Mutual funds, although still a good option for those seeking active management and possibly higher returns, are placed in Category C, reflecting their higher fees and reduced liquidity. 5. Real estate. Investing in real estate is widely recognized as one of the most profitable investments, especially for those who have experience and knowledge in the field. Residential, commercial properties, and land offer not only the potential for passive income generation through rentals, but also significant capital appreciation over time. For savvy and well-informed investors, the real estate sector can be extremely rewarding. The ability to identify properties with high potential for appreciation or undervalued in strategic markets is crucial. Experienced investors know how to maximize returns, managing properties efficiently and using strategies like development and improvements to increase their value. However, for those less experienced, real estate investment can represent a series of pitfalls. Lack of knowledge about the real estate market, the legal complexities involved, and poor property management can lead not only to missed opportunities, but to significant financial losses. Limited liquidity of real estate can also become a problem, as selling a property quickly is not always possible and can result in sales below market value if the need for liquidity is urgent. In addition, investing in real estate requires a considerable initial capital and is subject to market fluctuations, maintenance fees, property taxes, and other operational costs that can erode profits if not well managed. Location continues to be a determining factor in the success of real estate investment, with properties in desirable or growing areas showing the best returns. Therefore, for those who understand the market and know how to handle its complexities, real estate is classified as an S-category investment in our tier list, reflecting its high potential for return. But remember, this is if you know what you're doing. 6. Vehicles. Investing in vehicles encompasses everything from acquiring classic and luxury cars to buying more affordably priced vehicles for resale after improvements. The idea is to acquire a car at a reduced cost, perform adjustments or restorations, and then sell it for a higher price, or acquire a classic or luxury car for it to appreciate over time, becoming a long-term valuable asset. We will specifically talk here about the first case, when you acquire a car at a reduced cost, make adjustments or restorations, and then sell it for a higher price. This type of investment can be very lucrative for those with mechanical knowledge and a good sense of the market. Understanding which models are in demand and which improvements significantly increase the vehicle's resale value is crucial. For example, small restorations or modifications that improve the performance or aesthetics of the car can substantially increase its resale value. However, like any investment involving physical goods, investing in vehicles for resale has its risks. The costs associated with buying, maintaining, adjusting, and selling the vehicle must be carefully calculated. Expenses such as parts, repairs, storage, and even marketing for the sale can reduce the final profit. Additionally, liquidity can be a limitation, as finding buyers willing to pay the desired price can take time. This is especially true for cars that are modified in specific ways that may not appeal to a large market. This type of investment also requires a great deal of patience and skill in negotiations, being ideal for those who have a passion for cars and a deep knowledge of what makes a vehicle special and desirable. In terms of ranking in our tier list, investing in vehicles for resale with profit after adjustments can vary widely. For the more experienced, this investment can rank in higher categories like A. On the other hand, for those without the experience or necessary resources, this type of investment can be risky and ranks almost at the base of our tier list in category D, reflecting the challenges and uncertainty involved. 7. Commodities. Investing in commodities, which includes natural resources such as gold, oil, natural gas, and agricultural products like coffee and soy, is a classic way to diversify investment portfolios. Commodities can be a hedge against inflation and have the potential to offer substantial returns when market prices are favorable. One of the great attractions of investing in commodities is their ability to act as an insurance against adverse economic events. For example, gold is often seen as a safe haven during periods of political uncertainty or financial instability. On the other hand, commodities like oil and natural gas can benefit from periods of robust economic growth, where the demand for energy increases. However, investing in commodities also presents considerable risks. Prices can be extremely volatile, influenced by a variety of global factors, including government policies, weather conditions that affect crops, and changes in international economic markets. This volatility can result in high returns, but also significant losses. Liquidity varies significantly among different commodities. While precious metals like gold and silver are relatively liquid, other commodities, such as certain agricultural products, may be less liquid and more difficult to sell in times of need. From the perspective of accessibility, directly investing in physical commodities can be challenging for the average investor due to storage needs and associated costs. However, alternatives like commodity investment funds, futures contracts, and ETFs make this market more accessible. Considering these factors, investment in commodities can be positioned in Category C of our tier list. Although it offers opportunities for diversification and protection against inflation, the high level of risk and volatility requires an informed and cautious investor. 8. Cryptocurrencies. Investing in cryptocurrencies has become one of the most popular and debated ways to put money into the market in recent years. This type of investment is known for its high volatility, but also for the potential for extraordinary returns. Cryptocurrencies like Bitcoin, Ethereum, and other altcoins represent a new era of digital assets that offer a decentralized alternative to traditional fiat currencies. One of the biggest attractions of cryptocurrencies is the possibility of large gains. Investors who got in early on currencies like Bitcoin have seen their investments grow exponentially. However, it is important to remember that just as gains can be impressive, Losses can also be devastating due to the aforementioned market volatility. Additionally, cryptocurrencies offer a reasonable degree of liquidity, as many exchange platforms operate 24 hours a day, 7 days a week, allowing investors to buy and sell their coins as needed. This is a strong point compared to other types of investments that may require longer periods to liquidate. Accessibility is another positive point for cryptocurrencies. With just an internet connection and a digital wallet, anyone can start investing in crypto assets regardless of the initial amount available, which democratizes access to this type of investment. Considering the risks and opportunities, cryptocurrencies are classified in Category C. They offer great potential, but with a level of risk that should not be underestimated. 9. Real estate investment funds. Real estate investment funds, known as REITs, real estate investment trusts, are investment vehicles that allow investors to put their money into portfolios of real estate without necessarily having to buy or manage physical properties. REITs are especially attractive because they offer a way to generate passive income through dividends, usually distributed from the income earned from rentals. One of the great benefits of REITs is diversification. By investing in a REIT, you gain access to a wide range of properties, reducing the risk associated with investing in a single property or location. REITs shares are traded on stock exchanges, facilitating quick buying and selling, similar to stocks. With investments that can start with a few hundred reals or dollars, they offer a less expensive entry point into the real estate market compared to the need for large amounts of capital to acquire properties directly. A very important point is the potential return on this investment. To get any considerable return, you need to have a well above average capital. With this type of investment becomes very good in the long run, but not so much in the short term. Considering these factors, REITs are classified in Category B of our tier list. 10. Term deposits, fixed income funds. Term deposits and fixed income funds are forms of investments considered safe and conservative. They involve allocating money in banking products or securities that promise a fixed return over a specified period. These investments are ideal for people looking for stability and have a significant aversion to risk. One of the main attractions of term deposits and fixed income funds is predictability. You know exactly how much return you will receive at the maturity of the deposit or during the term of the fund, which facilitates financial planning and personal budget management. When it comes to liquidity, term deposits may be less flexible, as penalties are often applied for early withdrawals. However, some fixed income funds offer better liquidity, allowing redemptions with fewer restrictions. Both investments are quite accessible to the average investor. Term deposits have very low minimums, and fixed income funds can be equally accessible, depending on the fund. Regulation in these types of investments is also strict, providing a high level of security and transparency for investors. In summary, term deposits and fixed income funds offer a solid solution for those looking for safety and predictability. Therefore, they are classified in Category B of our tier list, reflecting their low-risk profile and stable but moderate returns. 11. Venture capital. Investing in venture capital involves allocating resources to startups and early-stage companies that have high growth potential. This type of investment is known for its high ability to generate significant returns, but also comes with a considerable level of risk, as many startups fail in the early years. The great advantage of venture capital is the potential for return. Investors who get in at the start of a successful business can achieve exponential profits if the company grows and eventually is sold or goes public. These success stories can be transformative, but they are the exception, not the rule. The risk associated with venture capital is substantial. Most startups face numerous challenges, and many do not survive beyond the early years. Additionally, these investments are illiquid. The invested money is locked in the company for several years, with no guarantee of return, and can only be recovered if the company is sold or goes public. IPO. Accessibility to invest in venture capital has varied significantly with the advent of crowdfunding platforms and collective investments, which allow smaller investors to participate in these opportunities, which were previously accessible mainly to institutional investors and extremely wealthy individuals. Regulation in venture capital is complex and varies widely depending on the jurisdiction. Investors need to be aware of local regulations, which can affect everything from who can invest to how profits are taxed. Given the high-risk profile, but also high potential for return, investment in venture capital is attractive to those willing to accept the possibility of losses in exchange for the chance of substantial return. Considering the need for specialized knowledge, a network of contacts, and a good dose of patience, this type of investment is positioned in Category C of our tier list. It offers great rewards for those who succeed, but is accompanied by volatility that is not suitable for all investors. Ladies and gentlemen, I sincerely hope you have found valuable insights and information to guide your investment decisions. If you have other forms of investment in mind that you would like to see analyzed and included in a future tier list, please leave your comment below. Your interaction is very important, and based on interest and comments, we may consider doing a part 2 of this video. Until next time,